Auditors use what are called key performance indicators during an audit to try to gauge the risk environment for a company. Basically, these are different indicators that show how well management is doing and operating the company. And some of these KPIs you've seen before in managerial accounting when you study ratio analysis. So things like return on equity, return on assets, those are different measures that not only auditors but managers, investors use to kind of analyze the performance of a company. And those are used in practice kind of in general by different companies. Now, there's some KPIs that vary by industry that are specific for certain types of companies. Notice we have this example here of a company in the airline industry. So we're looking at this specific KPI, revenue per flight for this company. Notice the blue squares here are occupied seats. We have the white ones are unoccupied. So if we have a company that has kind of revenue per flight or occupancy rates like this, right, that might be an indicator that they might have issues with revenues. We might want to specifically look at the revenue account to worry that maybe they might try to overinflate the revenue in light of kind of the lackluster performance this particular performance indicator is kind of showing us. Now, likewise, here's another KPI that's specific to a certain type of company. So we have a company here that sells baked pies. We could see their inventory turnover month to month, comparing those ratios from one month to the next. This might give us some clues about the inventory account and their sales revenue account. So looking at this type of ratio analysis helps us figure out if we should focus in on specific accounts. Now, these are both different types of analytical procedures. We see here other ratios, again, which would be considered analytical procedures, earnings per share, the EPS calculation, our PE ratios. So these are all things that you've probably seen in the past in other courses, just like key measures, key calculations that the businesses want to make based on their financial statement numbers to give them a clue how well they're doing. So both managers and auditors are going to crunch numbers like this. And specifically auditors in this risk assessment stage need to crunch numbers like this to get a feel for how the company's doing overall. Now, this ratio analysis is only one form of analytical procedures. So there's a bunch of different analytical procedures we're going to use in the risk assessment stage. And also once the auditor moves on to the risk response stage, they'll continue using analytical procedures to try to get some clarification on account balances for individual accounts. So these analytical procedures can be used at different points in the audit. Specific to the risk assessment phase in the audit, one of the big focuses of the analytical procedures there is to highlight unusual fluctuations in accounts. So imagine you're looking at a company's revenue account and it's pretty consistent all year long, and you see it has a big uptick in December. So it could be possible, if that's the end of their fiscal year, they have some sales from January that they're kind of backdating into December, and that would be a violation of the matching principle and a violation of GAAP. So that big uptick might indicate there's a problem there. Maybe it warrants us paying special attention. Or it could be that's just a typical seasonal uptick. Maybe it's a company that has an uptick in sales during the holidays typically, and that piece of information isn't anything special. It's really about the context, but we want to look and conduct these analytical procedures and look at different ratios together, taking into consideration the company's business model and business conditions in general to kind of get a feel to aid the identification of risks that the company faces. And this is also going to help us understand the client and its industry. So we just don't want to look only at analytical procedures focused on our company. We also want to look at ratio comparisons between our company and other companies in the industry to get a feel if there's some outliers going on with the company that we're auditing. And also these analytical procedures need to be focused on identifying accounts that may be at risk of containing material misstatements. So we want to minimize this audit risk wherever possible. So this risk assessment phase, when we're using these analytical procedures there, we're trying to set the stage to kind of plan the audit smoothly going forward. Now we're going to take a look at a couple different examples of analytical procedures. at play. So we talked a little bit about ratios. We're going to look at some more specific ratios here in a minute, but this analytical procedure, specifically on this slide, is what we call trend analysis. So we're just looking at changes in financial statement accounts over time. Notice here for this particular company, their cost of sales account, we're comparing this over the course of 4 different years. We start with 2025, and notice we're looking at 110 to begin with million. That was our cost of sales in this year. We're showing how much it changed over the next 3 years. So in 2025, it went down by 10%. All right, stayed steady between 2027 and 2025. And then by 2028, it went up 10%. So the total cost of sales for this company only went up by 10%, where revenues, sales went up by 20%. So for an auditor, if you're looking at this information when you're starting out the audit, when you're going through this risk assessment phase, you're going to think, well, that's kind of unusual. Usually cost of sales and sales should have some type of close relationship. So sales went up by twice as much as cost of sales. So that could be indicating there's issues with the numbers and the financials, or it could just indicate the company's doing well utilizing its resources, drumming up extra sales, but it's not costing as much as before. There could be different explanations for the numbers. When you're looking at this as the auditor, right, you're kind of just looking for areas of further inquiry at this point. So that'd be a potential area of concern. Maybe something's going on where we're underreporting expenses or overreporting revenue. So that's one way that trend analysis could be used to help us when planning the audit. Likewise with common size analysis, you probably recall this from one of your earlier accounting classes where you're looking at percentages in this case. Now we're looking at year over year comparisons again, but we're looking at different accounts of the financial statements as a percentage of some benchmark. So here we're looking at income statement. So we're using sales revenue as the benchmark, right? We're looking at every other account here as a percentage, all right, of sales. So notice our cost of goods sold in 2025 was 44%. Whatever that number was, it was 44% of the total sales revenue number. And we can see that's kind of changed from one year to the next. A little bit of a different comparison than last slide. But again, kind of talking about year over year numbers changes. So notice cost of sales, it's kind of dropped over this 4-year period from 44 to 40. So the auditor might be wanting to look into that further. Again, maybe it can indicate the company's missing some expenses associated with their cost of sales. It has gone down over time, or maybe they're minimizing cost of sales. They're doing a good job being more efficient over time. So there's different explanations for why these numbers might change. As an auditor at this stage of the audit, again, you kind of want to look into this stuff just to kind of get a feel for different areas where you might want to put more focus on in the audit. Right here with total assets, notice in this case, the benchmark that we use with the balance sheet accounts typically is total assets. So for everything below total assets, these percentages are in reference to the total assets number. So in 2025, cash was 5% of our total assets. So imagine if this company had $100 million in total assets, cash would have been $5 million. All right, so we can see cash has gone down as a percentage of total assets over this period. That might be an indicator that the auditor needs to take a closer look at the cash account. Why is less cash being carried within the company? Maybe they're doing a better job managing cash, so that could be a good sign. Or it could be a potential warning sign that something's going on with cash. Maybe it's being misappropriated. Possibly that's going to be a big area where, of course, auditors are going to want to look at possibilities of that happening. So numbers like this, analysis like this, helps the auditor kind of pinpoint different potential problem areas in the audit. So we talked about ratio analysis earlier. There's 3 specific broad categories of ratio analysis. We want to look at each one of these individually. Profitability ratios are probably the most common types of ratios actually calculated by investors. And notice there's a number of examples of profitability ratios here. You've probably seen most of these in the past in your accounting journey somewhere: profit margin, return on assets, return on equity, should all be pretty familiar to you. They're all just a different way, a different perspective of looking at the company's profitability. So of course, this is really important for investors. They want to have a feel for, how profitable a company is if they're thinking about investing in it. But auditors as well will be interested in looking at these ratios. Remember, one of the things we talked about in the past is, the profitability of a company. If they're really in a profit crunch, that might lead them, or that might be an incentive for them to commit some type of fraud. So we want to be looking and have some type of way to gauge whether they are in fact profitable or not. So this form of analytical procedure helps give some clarification on that issue. We could see another category here, liquidity and activity ratios. The liquidity ratios are kind of giving us some insight into the company's ability in the short term to pay their debts off, right? So you're looking at accounts receivables, you're looking at payables, and basically you're comparing current assets to current liabilities. And if this is a ratio is low, or we have more current liabilities than current assets, that's kind of a warning sign that the company might be in a short run financing crunch. Now, think of that in comparison to solvency ratios. Solvency ratios are long term. So that current ratio is used for short term analysis of how easy it is for a company to pay its bills. Things like the debt to equity ratio times interest earned ratio, these are more of a long-term perspective. Can the company meet its debt load in the long term? So it took on so much debt, there's current ratios, things like that. That helps us figure out, in the short run over the next couple of months, can they pay their bills, right? Solvency ratios, long-term perspective. So the auditor wants to take into account lots of different information like this, lots of analytical procedures, bring together all of these different facts and figures to kind of draw a conclusion of what's going on with the company. Again, we're trying to figure out how we're going to direct the audit. We're coming up with a strategy on where we're going to focus our attention down the road. So let's say a company did an analysis of a client, and they came up with these numbers, and they're kind of comparing the company, in this case, this example, Bayou Sports Shop, with industry averages. And notice we have things like receivable turnovers in days. So this is a good indicator of kind of a company's credit policy, or folks paying their bills on time. Then we see inventory turnover in days. This is kind of a measure of inventory management. And in both cases, you can kind of compare Bayou versus the industry. Their numbers are slightly different, but no major differences there. Their current ratio, a little bit lower than industry average. That might be a little bit of a warning sign, but still it's kind of close. So I'd say in these first three categories, if we crunch these numbers as the auditor and did this comparison, we'd be feeling pretty good that, the couple areas we're looking at right here, they don't look very problematic. But then when we look at the debt to equity ratio, all right, notice Bayou has a 1.21 debt to equity ratio. The industry average is only 0.5. So they've taken on a lot more debt than other companies in the industry. So this could be a potential warning sign that there might be issues